Okay, today we're looking at a really provocative call that's making waves in the metals world.
Uh-huh.
It comes from Michael Oliver, who, as you know, is one of the most disciplined technical analysts out there.
Right, known for his rigorous work, not just guessing.
Exactly. And he's not just predicting a big move in silver, he's actually arguing that the recent sell-off, near $50, totally fake, manufactured.
It's a bold claim, especially when you see gold pushing past $4,000 and other metals finding new ranges. Silver's just sitting there.
Like a coiled spring, as he puts it, stuck into that $50 level.
Yeah, it really stands out as lagging.
So our task today is to really unpack Oliver's argument from his latest video work. He calls it a potential quantum leap for silver.
A quantum leap, wow.
We need to look at the specific technical triggers he's watching, understand the history of this price action, and see if the fundamentals line up.
Because the prediction isn't just up, it's explosive. Potentially well over $100, and fast. Within months, he suggests.
And it hinges on his unique analysis, right? Not standard charting.
That's the key. It's his momentum spread analysis. Looking at silver relative to gold, the rate of change. He believes the recent drop wasn't a top,
What a shakeout.
a final engineered shakeout, designed specifically to trap the short sellers right before the price escapes for good.
Okay, this sounds like analysis you won't want to miss going forward. If you value getting this kind of forward-looking insight quickly, make sure you're subscribed to Tria Diavi.
Absolutely. It helps you stay informed and, frankly, potentially ahead of the curve.
All right, let's dig into this silver trap. We saw gold hit new highs. Silver popped above $51 briefly.
And then, bam, a sharp drop.
Yeah, and the headlines immediately screamed, crash, or top is in. Predictable, maybe?
Very predictable. But Oliver,
Mm-hmm.
he completely rejects that narrative. He calls the selling right around that $50 mark idiot selling.
That's a blunt.
It is. He uses that term, I think, deliberately. He sees it as a manufactured move, a trick, fooling people into thinking the old $50 resistance is still the main story.
But hang on, $50 is a huge historical level.
Yeah.
Isn't it just logical profit-taking, people remembering 2011?
That's the conventional view, sure. But Oliver points to the specifics. He notes that in the December futures contract, the price actually topped out just below 50, 49.768 to be exact.
Just shy of the big number.
Right, his interpretation. Short sellers were making small bets right under the line, thinking it would hold. The market let it drop back a bit, making them feel smart.
Sucking in more shorts.
Precisely, baiting the trap, building up a bigger pool of exposed shorts.
Who are now vulnerable.
Very sitting ducks, as the saying goes. And this leads to the really dramatic part of his forecast.
Okay.
He thinks when silver does break $50 decisively, the move will be so fast, so explosive, those shorts won't even get a chance to cover gracefully.
What does that look like mechanically? A violent move, you said.
He's talking about a potential limit-up scenario. So picture silver closing at, say, $49 one day. The next morning, it doesn't just gap up 50 cents or a dollar. It opens $3, $4, maybe $5 higher, instantly hitting the exchange's maximum allowed price move for the day.
Limit up. Trading halts on the upside.
Exactly. Trading stops. Anyone short needs to buy back to cut their losses, but they physically can't. There are no sellers at those lower prices. The market's locked at the high.
Wow, so they're trapped.
Oliver's phrase is, nails them to the wall. They're stuck, watching the price soar, unable to exit until maybe the next day, likely at an even worse price.
And he frames this not as just market mechanics, but as escape.
As silver finally breaking free from decades of what he sees as suppression and irrational pricing, a massive short squeeze triggered by escaping that range.
That potential for sudden sharp movement definitely creates urgency.
Yeah.
But let's step back. Why is silver still stuck between $20 and $50? Gold's broken out, copper's broken out.
Even things like lead and zinc.
Right. Why is silver the odd one out? What makes him talk about a new reality?
Well, look at those base metals he mentions, like lead and zinc. Back in the 90s, early 2000s, they were stuck in a low price band.
Uh-huh.
Then, around late 2006, they took off, tripled roughly.
And the key point is, they didn't just spike and crash back down.
Exactly. They found a whole new level, a new trading range, maybe double or more their old zone. And for the last, 10, 15 years, they've stayed up there. They never went back.
They established a new floor, a new reality.
Correct. But silver, despite the 1980 peak, the 2011 peak, It's still fundamentally contained within that old range.
while gold and copper are above their 2011 highs.
Precisely. Oliver basically says this is ridiculous, an irrational level, given everything that's changed, money supply, industrial use.
So the technical argument isn't just for a rally, it's for a complete shift, like those base metals, finding a permanently higher price zone.
That's the core idea, a phase shift. Blasting out of this decades-long bracket into maybe $100 to $200 range eventually. And he thinks the breakout move itself, the part that traps the shorts, could happen really quickly, maybe in the next 2 quarters.
Okay, timing. That brings us to his specific trigger. It's not the usual gold to silver ratio, right? Everyone watches that.
No, he flips it. He uses the silver to gold spread, measures silver's price as a percentage of gold's price.
Interesting. Why? What does that show?
It measures the relative energy, the relative suppression. It shows how much silver is lagging or potentially coiling up relative to gold.
And where are we now on that measure?
Right now, silver is only about 1.2% of the price of gold, which he describes as extremely low, historically very suppressed.
How low compared to history?
Well, think about this. Even in average years, non-bull market years, silver hit 2% of gold's price in 21 of the last 50 years. And back in 1980, it peaked at 6.5%.
Wow, okay, 1.2% is definitely low then. So
Yep.
what's the magic number, the trigger?
His analysis points to a critical breakout level on this spread chart. It's a pending triple top breakout at 1.31%.
1.31%. Why that specific number?
It's the key resistance level on his spread chart. And here's the kicker. He says breaking that exact 1.31% level on the spread preceded the huge vertical moves twice before.
When?
Late 1979, just before silver went from the 20s to $50 almost overnight, and again in late 2010, right before the next big surge to $50.
So breaking 1.31% on this specific measure has historically signaled the start of those near vertical ascents.
That's his finding. It's the signal that the suppression is breaking and the real momentum is kicking in. He's basically warning, watch this 1.31% level. Once it breaks, the move could be enormous and happen fast, maybe within 5 or 6 months.
A proprietary signal that most aren't watching. That's the kind of edge people are looking for.
It absolutely is.
And if you find value in understanding these less common indicators, these potential early warnings, subscribing to CRBA is really the best way to keep getting this kind of distilled analysis.
Yeah, we focus on bringing these specialized insights to you quickly and clearly.
Okay, let's switch gears slightly. The technicals sound explosive. But what about the fundamentals? Does the underlying economic reality support such a dramatic forecast?
Oliver argues it absolutely does. It's a combination, really. A perfect storm of decaying fiat money and absolutely critical surging industrial demand.
Let's start with the money side. Fiat decay.
Right. Since silver's last peak in 2011, think about how much money has been created globally. Global M2 money supply is up more than 150%.
Just enormous amounts of new currency flooding the system.
Which means each dollar, each euro buys less. Oliver actually did the math.
Okay.
He calculated that the $50 silver price from 1980, if you just adjust it for inflation and the loss of the dollar's purchasing power since then,
What would it be today?
over $250 an ounce.
$250.
Yeah.
And we're still below 50.
Exactly. It just shows the sheer scale of the monetary distortion that he believes needs to correct. Silver hasn't even caught up to its old inflation-adjusted high.
And on top of that monetary pressure, silver's role in the economy has fundamentally changed, hasn't it?
Massively. This is the second pillar. It's not just money anymore. It's an indispensable industrial metal.
Solar panels.
Solar panels use a lot of silver paste. Batteries, electronics, and then you have huge government spending worldwide on green energy, infrastructure, all needing silver.
So demand isn't just cyclical, it's structural and growing.
And crucially, the supply side isn't keeping up. Mine production has been pretty much flat for years.
Stagnant supply, record demand.
Creates the tightest supply situation among almost all major metals. So you have this monetary pressure cooker, massive industrial demand, and a lid clamped on supply.
So the argument is the market made a mistake holding the price down this long. And when markets correct mistakes like that,
They tend to correct violently. History shows that when an asset price gets this suppressed, this irrational, the eventual correction doesn't just drift back to fair value, it often overshoots.
which leads back to his $100 to $200 predicted range. Not just inflation catch-up, but an overcorrection.
Exactly. The market searching for and maybe overshooting the true price after years of being misled.
Okay, so wrapping this up, Michael Oliver's core message seems very clear. Ignore the noise around the $50 crash. Don't be fooled.
He sees it as a turning point, not a top, the end of the suppression.
And the pieces are aligning. This long-term price distortion, the specific 1.31% technical trigger on his spread chart, combined with runaway industrial and monetary demand.
All converging on a supply chain they can't keep up.
And the final warning: urgency. If he's right about the way it breaks out, that limit-up scenario waiting for confirmation means you've already missed the boat.
You won't get a chance to react at a good price. You'll just wake up one day and $50 will be ancient history.
It really leaves you with a powerful thought, doesn't it?
It does. Consider this. Based on the data, since 2000, gold is up something like 16-fold. But M2 money supply, the S&P 500, they're up maybe 4.5-fold.
Big difference.
Huge. It shows how much real, essential assets can outperform when money gets debased. Now, given silver's history of moving even faster than gold in these breakouts and its critical industrial role today, what does that 16x versus 4.5x gap suggest about the kind of stored energy, the pent-up buying power, just waiting inside this still suppressed asset?
It suggests the potential is extraordinary, and understanding the triggers is crucial right now.
Absolutely.
We really urge you, if you value this kind of analysis, subscribe to Devia. Stay informed, and share this discussion with others who need to understand what might be unfolding in the silver market.